Welcome to chapter 8. In this chapter, we'll be discussing about working capital assessment. So far in the previous chapter 7, we have discussed about term loan appraisal. We have discussed the various facets of term loan appraisal, how to go systematically while assessing a term loan proposal, what are the aspects that need to be considered in a term loan proposal. So in this chapter, we'll go to the other aspect of finance, of bank finance, equally important, in no way less important than term loan finance. It's known as working capital, right? So in this chapter we'll be discussing about the various ways in which you're going to assess the working capital requirement of a company. So the concept of working capital is very simple. It's not complex. It's a very simple concept. It's like the petrol in your car. Okay, if you buy a car for 5 lakh, really it's of no use. The asset as it is of no use. Over and above the cost of the car, you need to spend say 100 rupees per day, to make the car move. Okay, to make the car move, you need fuel, right? So irrespective of the cost of the car, this might be a 5 lakh car or a 50 lakh car. If you don't put in this small amount, the car will not run, right? It's not really about the amount. Amount might be very small, but if this amount is not pumped into the car in the form of petrol, the car will not move, right? So this is what we call as a fixed cost. Okay, this is the fixed cost, and this is what we can call as a running cost. Okay, because it's a running cost, because this 100 rupees will make the car move only for today, maybe for 10 kilometers. It's only for today. Tomorrow we need to spend another 100 rupees, right, to move it another 10 kilometers, and the day after another 100. So it is a continuous expenditure, right? It is a recurring expenditure, and that's what I mean by a running expense. Okay, so this amount is small actually. If you compare with the cost of the car of 5 lakh, this amount is small, but then it's the lifeline of the car. If you take out this amount, this running expense, this petrol, the car will not move. This entire 50 lakhs, this entire 5 lakh or 50 lakh, whatever it is going to be waste. Okay, so understand the concept of working capital. It's a running expense. It's expense that need to be incurred continuously. Similarly, in companies also, it's not enough if you have fixed assets. So in the previous chapter, we discussed about creation of fixed assets. We use what we use a facility what is known as a term loan. Okay, so using term loan we create fixed assets. So just as in the case of the example which we have considered, a car and a fuel, the car is a fixed asset, right? So we can create a lot of assets, fixed assets, like the company might have purchased a huge tract of land, constructed a lot of buildings and civil works, imported the best machinery, but all of these are basically fixed assets. Okay, so because fixed assets by themselves cannot do anything. By themselves they cannot do anything. They wait for something to come in. Hopefully that something will come. They wait for it, because until they come, these fixed assets cannot do anything on their own, and that something is known as the working capital. Because if the working capital fails to turn up, fixed assets are useless assets. They can't do anything. Okay, once again the amount may be small. In the previous example we said the cost of the car is 5 lakhs, whereas the working capital is just 100 maybe, right? So here also the fixed assets usually will be running into crores for a major company, right? For a major project it will be running into crores, but working capital might be small. It might be lakhs or few crores, but the point is the amount is immaterial. If this working capital doesn't arrive, the project doesn't function, right? So this working capital should be timely and should be adequate, and unless the company gets this working capital both in time and in an adequate quantity, the project cannot run efficiently, right? So what is working capital used for, right? So we said the working capital is a running expenditure. It's basically this is used for meeting day-to-day expenses. So meeting day-to-day expenses, these are running expenses because they need to be incurred every day, just like petrol. Just like petrol. In the example we have considered that petrol, the car consumes petrol continuously and you have to refill it. Similarly, these day-to-day expenses for a company are also recurring in nature. Take for example raw material. You purchase raw material, you put it into the production process, and then out comes a finished product, and you sell it. But with that, the role of this raw material is over. Once this product is completed, finished product is generated, the raw material is done. You cannot use that raw material again to manufacture another product. For that, you need to purchase an additional raw material. So continuous production, you need to keep on producing, keep on purchasing raw material. So it's a running expenditure. Are you understanding this concept? The running expense. When you mean by running expense, this is not a fixed expense. See, unlike a machinery. A machinery is something called a fixed asset. You purchase it once, and it keeps on producing for a long period of time, for the life of this machinery. Maybe this machinery works for 10 years. For 10 years you need not spend a rupee during the maintenance repairs cost. You need not purchase the machine again. This machine keeps on producing item by item. It is a fixed expense. It is a one-time expense. But there is another category called the running expense. In this running expenses, you need to this needs to be incurred continuously every day, right? In case of your family, right? In your family, you can think of fixed expense like a house. You don't purchase a house every day. You purchase it once and you live in it, right, for a lifetime. House. Whereas your running expense, take for example your food expenses, your monthly provisions. Take for example rice, or flour. This is something which you need to purchase every day. This is a running expenditure. So please be clear on the distinction between the fixed expenses and the running expenses. So for the company, raw material is a very good example, right, of a running expense. Similarly, power. The company incurs a huge power bill, right? Every month it has to pay the power bill to the electricity company for production. This is something that is recurring. Every month it has to incur, right? So this is a running expenditure. So working capital is used for meeting day-to-day expenses, or in other words, running expenses. The most important point that you need to always remember in this concept of working capital is cash. Cash is important. You require cash. Business needs cash. It is the ultimate objective. You need cash, but cash is very often is disguised in another form. You don't find cash in the form of cash. If you look at the company will be having some cash on hand. Okay, on hand it will be having some cash, and maybe in the bank, in the CC account, it will having some cash. Okay, this is what is known as the true cash. But if you really look at it, there are other forms of cash. It is just that cash is not in the form of cash. It is disguised in other form. Right? Take for example, raw material. Raw material is actually cash. In a way, if you think about it, raw material is also cash, because you bought this raw material by paying cash. Okay, so once you purchased raw material, you purchased raw material by paying cash. So cash got converted into raw material, right? And then you're applying some production techniques, some the raw material, and out comes the finished goods. You're going to sell it again, right? And then you're going to realize cash. This original cash plus some profit. Okay, you're ultimately going to sell it at a higher price than the cost. So essentially, this cash is coming back. You see here in this cycle, the cash is coming back. It is just that in this intervening period during the production process and for a period after the sales, known as the credit period. During this period, it is not in the form of cash, the true cash as we know it. It's not in the form of currency, hard cash, right? But it is in a form which will ultimately be converted into cash. See, this raw material, and during the process, during the production process, and once it's converted into finished goods, during all this process, it is just that cash is changing form from one form to another. Initially, it is in the form of raw material, then in the form of work in progress, then finished goods, then debtors. So cash is changing form. It's in a disguised form. It is not in the form of the true cash which we know, but ultimately it's going to be again converted back into cash. Right? Please be very clear on this concept. Cash will not always be in the form of cash in business. In any company, cash will be wearing a mask. You can think of cash is wearing a mask. At one stage it will be in the form of raw material, another stage in the form of finished goods, debtors. So there's various forms. There are various forms of cash. So raw material is a form of cash. Similarly, debtors, book debts. We already discussed while discussing sales that one of the forms of sales is a credit sale. It could be either cash sale or credit sale. Credit sale is a sale where you're not going to receive the amount immediately. You make the sale, the goods are shipped to the customer. The customer starts using that product, and ultimately after say 30 days or 45 days credit period, the customer will be making payment to you. So during this period, the credit period of 30 to 45 days, you're not going to get cash. It is what we know as debtors, book debts, receivables, accounts receivable. Okay, again this is cash. It is just that you have to wait for 30 days. You have to wait for 30 days before this gets converted into cash. But it will be realized. You see, it will be realized at one stage or the other. Same is the case with raw material. Raw material goes in the production process, gets converted into finished goods, and right, you're going to sell the product and you're going to get back cash. Similarly, book debts are going to be converted into cash. So if you look around in the company, everything is cash. To ignore for a moment the fixed cost, the fixed assets. Okay, fixed assets is also a form of cash, but anyway, that's not going to be sold during the in normal course of time. So ignore fixed assets for a minute. If you keep aside the fixed assets and you look around the company, everything is cash. Everything is cash. Go to the godown, raw material, finished goods, right? You go to the books of accounts. There are a lot of debtors, right? So everything is in a form. So there's a lot of forms in which cash is disguised. Okay. But you see, this is fine. This is from a company's point of view. There's going to be a process in which cash is going to be converted into various forms. That's fine from a business point of view. But this is not going to be accepted by, say, for example, your raw material supplier. You purchase this raw material from your supplier, right? And you have to pay. I'm not speaking of the sale part. The sale part is known as debtors. Okay. But there is a raw material part. You have to pay to the suppliers. They also gave you credit, say 30 days, right? You purchase raw material, but you didn't pay cash. They gave you 30 days time. After 30 days, you have to pay the cash, right? So these are known as what? Creditors. Okay, these are known as creditors. Now you cannot go to your raw material supplier and say, I'll take this 10 kg of finished goods and settle your account. No, you can't do that. He says, I want cash. Similarly, employees who work for the entire month, you have to pay the salary at the month end. You cannot say, I have a lot of debtors. A lot of customers are yet to pay to me. You go and collect from them and settle your salary from them. You cannot do that. So your finished goods, your raw material, your debtors are all, yes, yeah, they're a form of cash, but your customers or your raw material suppliers or your employees or your power electricity company, nobody's going to take this. They want cash. So there is a problem here. Everybody wants cash. Your stakeholders, the other stakeholders to whom you owe money, whether the employees or your raw material suppliers or any person whom you owe money, they want cash. They are saying we want cash, but you don't have cash, or at least you don't have sufficient cash to pay them. That gap, you see, that gap is the basic reason why we need working capital. See, the problem is not that we do not have cash. Please understand this point once again. It's not that we don't have cash. It's just that we don't have it right now. We have it in another form. We don't have it in the form of cash right now. But there are people who are demanding cash. We want payments. Your raw material supplier stays sitting on your head demanding payment. Month end, there are a lot of payments to be made to your employees, to the power company. There are a lot of payments, and everybody wants cash, but you don't have cash. So there you need working capital. So all this gives rise to working capital. You need working capital. Think of working capital as running capital. This is capital that needs every day. It's not a fixed expense like a plant and machinery. This is a running expense. You need it every day. Let us think of a example from a common from your everyday life. Okay, say for example, most of you are bank employees. So say a bank employee has a son who is studying in a college in a different city. All right, this son is studying in another city. Okay, so let us assume his monthly expenses are 3,000. Right. Let us also assume this son has received scholarship of 3,000. So actually there is no additional amount that the father needs to pay. So the son has monthly expense of 3,000 and he is receiving scholarship of 3,000 per month. But this scholarship amount will be given only at the end of the month, right? So what happens the first month, right, when the son joins the hostel? The father needs to give 3,000 to the son, because in the first month he is not going to receive the scholarship. It's only going to be received at the end of the month. So for the first 30 days, the son needs money. So the father gives 3,000. Okay. So once the month ends, the scholarship amount will come, and the son can say to his father, take back this 3,000 which you gave to me. Okay, it is settled. But for the second month again, you see, the son will again need 3,000, and again he has to wait for 1 month to get back the scholarship. So again he goes to the father, and again the father gives 3,000. At the end of the second month, he gets the scholarship. He gives back the amount to the father. But again he needs it the third month. That is clear. So. But you see, this total amount is not going to be the 6,000. See, at the end of the first month, see, this is the opening. Okay, opening. Let us think of this as a business proposition, even though it is not strictly. Let us think in the terms of that the son has borrowed 3,000 from the father. So on the first of the month, this is month 1, the son has borrowed 3,000. So at the end of the month, there is not going to be any debt, because the scholarship amount is going to come and he's going to be repay his father with 3,000. So there are no debt. But at the second month again, he needs another 3,000. Because the scholarship for this month will be coming only at the end of the month. So again there will be 3,000 debt, right? And this will be closed at the month end. So at any month, if you see, it goes on. Every month he's going to require 3,000. So this we can say what is known as working capital. Okay, please note that it's not going to be 6,000 at the end of the second month. At the beginning of the second month, even though the father has given 3,000, it's not going to be cumulatively add up. It's not going to add up. This 3,000 won't add up because this 3,000 is going to be settled at the month end through the scholarship. So at any point of time, it's going to be 3,000, right? So this 3,000 is something, in a way you can call it as a working capital. I'm just trying to draw an analogy between the a situation which is common in everyday life to a company's perspective. What's happening here is the you see here there is a point, a very subtle point you need to understand. The son is actually repaying the 3,000. Every month he's repaying the 3,000 because at the month end he's going to get the scholarship. This 3,000 which he borrowed at the beginning of the month, he's repaying it actually. But again, the debt is going back to the 3,000 because the next month he needs another 3,000. So the debt is never coming down to 3,000, coming down below 3,000. It's never becoming zero because every month this is a recurring expenditure. Similarly, in the case of companies, they need working capital because money is always blocked in the form of current assets. In the previous example, the money was blocked in the form of scholarship. Okay. In the case of companies, there are a variety of ways in which this money is blocked. I told you that cash is blocked in a variety of assets. Cash is disguised in a number of forms. In other words, cash is blocked. What we are saying, cash is in many forms is cash is blocked. Cash is blocked in the form of raw material. Cash is blocked in the form of finished goods. It is blocked in the form of debtors. In various forms, it is blocked, and that's why the company is not having ready cash. But people are demanding cash. I told you, the raw material suppliers, right? The employees and many and everybody whom the company owes money are demanding cash, right? And the entire problem is the cash conversion is not instantaneous. What do you mean by cash conversion? In the earlier example, if the boy receives scholarship at the beginning of the month, on the first of the month 3,000, then he need not borrow from his father, because this 3,000 he'll be using for 1 month happily. At the second month, first of the second month, again he's going to receive 3,000. So at no stage he needs to borrow from his father. The problem is for 30 days he has to wait because the scholarship is going to come only at the end of the month. Similarly, here in the case of companies, the cash conversion is not going to happen instantaneously. Right now, this is very important. You have to understand why this cash conversion is not instantaneous. What is this process? What is this cycle? The cycle that the cash goes through. We said that cash ultimately converts back to cash, but there is a process involved. So what happens in this process? That is known as operating cycle. The most important concept in working capital assessment. We need to understand what is this operating cycle. So there are a variety of ways in which the cash is blocked. Okay, there's a typo here. This is raw material. Okay, so raw material stock. Fine. So we are speaking of the ways in which the cash is blocked, right? So why companies needs to have working capital. Okay. So first of all, companies need to maintain stock of raw material, right? Imagine a steel plant which produces the thousands of tons of steel every day. The raw material for a steel plant are iron ore, coke, and limestone. Okay, so let us assume that iron ore is not available in the vicinity. Okay, so it's located in some mines somewhere in Orissa, hundreds of again there's a typo, miles away. Okay, so if there is no iron ore, the production will stop. So what the company will do is, because the raw material is the lifeline of this production process, if the raw material doesn't arrive on time, it's not available for the day, the production has to be stopped for the day. In an ideal world, you can say, today morning 9 a.m. I'm going to start my production. You can tell to your raw material supplier, deliver to me 100 tons of raw material precisely at 9 a.m. In that case, you need not maintain any stock. This is a scenario where you can give instructions to your raw material supplier and say, you come at 9 a.m. exactly. I am not going to keep any stock. I need it at 9 a.m. You deliver at 9 a.m. What is the problem with this scenario? There's a huge risk, because if the raw material supplier doesn't deliver on time, the production will stop. Okay, so there are reasons why companies maintain stock of raw material. Let us see a few reasons why companies maintain stock of raw material. First of all, there's a time lag. There's a time lag between placing orders and receiving material. Right? See, the steel company, there's a process for ordering. It faxes the purchase order to the mine. Then the mining company will process the request, and right, and then it gets the quantity out of it go down. Maybe it goes for some specification selection and all this stuff, and finally dumps into the lorry, and lorry will take some time to reach the company. So there's a process involved. There's a time lag between placing order and receiving material. If I as a steel plant want the raw material today, I have to plan for it some say 1 week or 2 weeks before. because there's just a time lag between the placing order and receiving material. For that very reason, at least for that reason, we require to maintain stock of raw material. The other reason is, we already discussed, there is an uncertainty in receipt of the raw material. What if the mine suddenly stops functioning? There's a problem. There is a labor strike in the mine. There is no production. What if there is a lorry strike in the transportation? The transportation between the mine and the factory premises. That is affected. So there are a lot of uncertainties. Basically, business deals with a lot of uncertainty. So to play it safe, companies keep stock of raw material. So when I say companies maintain 1 month stock, what we are essentially saying is, for 1 month, even if the raw material doesn't arrive, the company need not stop its production. In common words, that is what it means, right? When we say the company is maintaining 1 month stock, what it means is, for 1 month, even if the raw material doesn't arrive at the site for some reason, the company still can go on with its production. So companies will maintain some stock due to these two main reasons. Main reasons are the time lag between the placing order and receiving material, and the uncertainty associated with the receipt of the raw material. Of course, there are some other reasons, like if you procure in bulk, usually there will be some discount, right? It happens in business, so that could be one reason. Convenience is another reason. Imagine in your house, the vegetable shop is very near to you. The vegetable shop which you go is very close to you. But then why don't you buy the vegetables every day? Usually you buy it for 3-4 days, once in 3-4 days, or once in a week. So you purchase all the vegetables in one go, and keep it in the refrigerator and use it over the weekend. Next week again you go. So what you're basically doing is, you're looking at convenience. You could go every day. And purchase whatever is required for that particular day. But then there is a convenience, because you are employed, your spouse is employed, you need to drop the kids at school. There's so many work. So there is also a convenience aspect. So companies cannot keep on ordering for, we require 1 ton today. Let us order it today. We require 2 tons tomorrow. This is very inconvenient. So these are the reasons why companies maintain stock of raw material, right? One more form in which cash can be blocked is work in progress. Okay, work in process. So, once raw material is received, it will be put into the production process. So, continuing with the example of steel plant, the raw material will be processed, and the in-between stage is known as molten metal. Okay, before it's converted into the final angles or channels or whatever. Before that finished good is obtained, there is an intermediate stage in the steel production process, where it's in the form of molten metal. This is a work in progress. Okay, work in process is basically semi-finished goods. Okay, you can call it semi-finished. It's not entirely finished. It is semi-finished. So if you visit the factory premises as on a date, 31st March, say for example, 31st March. On that day, you're going to find some raw material in the stock. This is untouched raw material. The company didn't use this raw material in the production process. There will be some raw material of that sort. Then there will be some finished goods in the godown. These are goods that are completed but are not yet sold. Okay, and then there will be something called semi-finished product, work in progress. This is neither raw material, this is neither pure raw material, nor it is completely converted into finished goods. This is the in between stage, and this varies from industry to industry. For some industry, work in progress maybe just in a few, maybe just a few hours, or minutes maybe. It's just that the raw material gets converted into finished product very fast. It could happen. Or in some industries like fermentation, the fermentation takes a lot of time, some weeks. Okay, so in that case, it will be in the form of semi-finished stage for quite a while. So it varies from industry to industry. But the point is, cash is blocked in the form of work in progress. Okay, in the form of work in process, there is some cash that is blocked, and the realization is going to take some time. When is the cash that is invested in this working process going to come out? This has to be converted into finished goods. It has to be sold. The customer has to pay, and then you're going to get back the cash. So still there's a process involved. During this stage, the cash is blocked in the form of work in process, right? So then obviously the other form in which cash is blocked is finished goods. The companies need finished goods. Just as we discussed the reasons for companies maintaining a stock of raw material, companies also need to maintain stock of finished goods. Why? When a customer comes to you to buy a product, you cannot just manufacture it out of air. Like magic you can't do. Out of air, come on, you can't say that. There is a process involved. So you manufacture in advance and stock it. So you stock the product so that you're going to meet the demand. And similarly, you cannot say to the customer, I don't have it now, you come back after 1 week. You can't take the order and then process it. Okay, you're going to lose customers to the competition. So companies maintain stock of finished goods so that they can meet the customer demand effectively, right? It varies from industry to industry again, and also depends on whether it is a seasonal industry or not. Because in seasonal industries, in some particular months, demand will be peaking. So then we will be so then the company will be requiring to maintain larger quantity of finished goods. So again, these are company specific issues. The point is, if you don't make the product available to the customer when he wants it, it's a it's loss of business to the company. Loss of business means you're going to lose the customer to competition. Okay, so companies need to maintain finished goods. So this is also a form in which cash is blocked. So another form in which cash is blocked is debtors. Debtors, as we discussed during credit sales, it's the debtors are people who to whom we have already sold our goods, but then we didn't receive cash. We are yet to receive cash. We are going to receive it very shortly, maybe 30 days or 45 days. Once the credit period is over, you're going to get back the cash. It's just that we have to wait for quite some time. Just wait for some time, maybe 30 days, maybe 60 days, maybe 90 days. Depending on the terms, you have to wait. But it is going to be converted into cash. So till that time, it's in the form of debtor. So this is also a form of cash that is blocked. Okay. So if you put all of this together, this is what we get. This known as the operating cycle. So it starts with cash. Okay, you actually start with cash. Then with this cash, you purchase raw material and you convert this into finished goods, right? So there will be a work in progress also in between, and then you sell it to the customer, and the customers will not pay immediately. They'll be given something called as a credit period. So during this period, you'll be having debtors. So then you collect the money, and then you'll get back the cash. So the cash you pump into the business is ultimately going to come back as cash, but cash with some profit. But that is going to take time. So this cycle is known as the operating cycle. It's a very important concept. This is exactly the reason why you require working capital. Why does a company require working capital? Why can't it manage with just term loan? Why does it come for sanction of working capital from banks? This is the reason. It is because the conversion of cash is not instantaneous. There is a time between the company pumping in cash and getting it back. This cycle could be months. For example, it could be 3 months. You don't know. Till that time, the company has to run the process. See, the company cannot wait for 3 months for this cash to come back and sit idle for the 3 months, because business is an ongoing process. The production needs to be done every day. So imagine this is a new company. Let us assume this is a new company, and we are saying the operating cycle is 3 months or 90 days. Okay, on day one, the company requires cash. The company requires cash to purchase raw material. It has not even made sales. So who's going to pay this money? It requires some amount. For the second day, third day, for 90 days is going to require, amount. All this is working capital. On the 91st day, it's going to receive the first sale amount. The goods sold that on day one, whatever it has sold, is going to receive the cash on 91st day. In this 90 days, the company has to process. And this is a cycle. We discussed this example of the son borrowing from the father for 3,000 to be his hostel expenses. Okay. So the 3,000 is going to continue. You've seen that, right? Why it continues for 3,000 every month? It doesn't come down to zero, because the next month again he needs 3,000. So similarly, the company, the funds keeps on gets blocked in some form or other. So there is something called a minimum operating. So there will always be a working capital. It's not enough if you use finance for these 90 days, and say on the 91st day, okay, pay me back this entire amount. You can't say that, because it's an ongoing process. Again, you require this amount is going to be required every day. Right? It's an ongoing process. So working capital never becomes zero. This is the cycle. This is the operating cycle. The basic reason why companies require working capital from bank. So with this, we come to the end of the segment. So in this segment, we have discussed the basics, the basic concepts of working capital. In the next segment, in 8.2, in segment 8.2, we'll be discussing about a very important concept known as NWC, net working capital. It is the starting point for much of the analysis we are going to do later. So in the next segment, we'll be discussing about net working capital. See you then.